Trading and investing are not just about numbers, charts, and graphs, they're deeply influenced by psychology. Today, we're diving into how the human mind shapes our financial decisions, and more importantly, how you can harness this knowledge to make smarter trades. Let's break down the psychological concepts every trader should understand. First up, cognitive biases. These mental shortcuts help us make decisions quickly, but they can also lead us astray. Let's explore 3 common biases in trading. Confirmation bias refers to the tendency to search for, interpret, favor, and recall information in a way that confirms one's pre-existing beliefs or hypotheses. In trading, this happens when you seek out information that confirms your existing beliefs, ignoring anything that might contradict them. If you're bullish on a stock, you'll notice every piece of good news and overlook the bad. Next, we have overconfidence bias. This is when you overestimate your knowledge and abilities. Overconfidence bias is the tendency for individuals to overestimate their own abilities, including the accuracy of their knowledge and judgment. When you think you know better than the market, you're more likely to make impulsive decisions. Anchoring bias occurs when people rely too heavily on the first piece of information they receive, the anchor, and use it as a reference point for all subsequent decisions. In trading, you might fixate on a specific price or data point, and it clouds your judgment for future trades. Loss aversion is a concept from prospect theory, which was developed by psychologists Daniel Kahneman and Amos Tversky. It refers to the idea that losses are psychologically more impactful than gains of the same size. In other words, the pain of losing something is greater than the pleasure of gaining something of equal value. For many traders, the thought of losing money is so painful that they refuse to sell a losing position. They hope it will rebound, even when the market tells them it won't. To overcome this, remember that losses are part of trading, and sometimes cutting your losses early is the best decision. Trading is often driven by fear and greed. These emotions can be dangerous because they lead to irrational behavior. Fear often leads to panic selling. When the market drops or volatility spikes, it's easy to give in to fear and exit positions too early, locking in losses that could have been avoided with a little patience. On the other hand, greed can drive traders to take on more risk than they should. The temptation to chase after quick profits often clouds judgment, leading to decisions that are too aggressive or speculative. One common mistake is the gambler's fallacy, a belief that after a series of losses, a win is due. The gambler's fallacy is the mistaken belief that past events and independent events, like flipping a coin or market fluctuations, influence future outcomes. Traders often fall into this trap, thinking that after a streak of losses, a win is inevitable, and this can lead to riskier, irrational decisions. In reality, each trade is independent, and the market doesn't have a memory of past losses. Don't let the idea of getting even dictate your decisions. Focus on strategy and long-term goals instead. Every trader has different risk tolerance. Understanding your own limits is crucial to creating a successful strategy. Some traders thrive in high-risk environments, while others prefer stability. Know where you stand. Are you comfortable with volatility, or do you prefer a more conservative approach? Building a trading mindset also means developing self-control. The most successful traders are those who can stick to their plans, avoid emotional reactions, and think long-term. Another psychological pitfall is herd behavior. When traders follow the crowd, making decisions based on what others are doing rather than their own analysis. This phenomenon can be explained by social proof. a psychological concept where people tend to follow the actions of others, especially in uncertain situations. This often leads to bubbles and crashes. Just because everyone else is buying doesn't mean it's the right decision. Stick to your strategy and avoid getting caught up in the hype. Finally, let's talk about delayed gratification. Delayed gratification refers to the ability to resist the temptation for an immediate reward in favor of a later, more substantial reward. Successful investing is about making sacrifices now for future rewards. It's easy to get distracted by short-term market fluctuations, but the most successful investors focus on long-term gains. By practicing patience, you'll avoid the emotional roller coaster that leads to impulsive decisions and give yourself the best chance of success. Understanding the psychology behind trading and investing is essential for success. By recognizing and managing cognitive biases, emotions, and psychological traps, like the gambler's fallacy, you can improve your decision-making and build a more disciplined approach. Remember, trading isn't just about the technical aspects. It's about mastering your mind. Stay informed, stay calm, and most importantly, stick to your strategy. Thanks for watching. If you found this video helpful, make sure to subscribe for more psychology insights. See you next time.